First up, let's have a look at the US dollar index, the DXY, which continues to struggle, hovering near a 3.5-year low as of Wednesday. It was last seen around 96.8. The currency remains under pressure due to dovish expectations from the Fed and concerns about President Trump's tax and spending plans. Fed Chair Powell said that the Fed is staying patient on further rate cuts, though he didn't rule out a cut at this month's meetings, saying decisions would depend on upcoming data. Markets are now focused on Thursday's June employment report for clues on the strength of the labor market and future Fed policy. Technically, the dollar index recently broke below the lower line of a descending wedge that's been guiding price action since mid-May, hitting a low of 96.38. The index is still well below its 9-day simple moving average at 97.5, highlighting the strength of the current downtrend. Momentum indicators remain bearish. The RSI has slipped below 30 into oversold territory, while the MACD histogram stays negative. Key support is now seen at 96, with February 2022 low of 95.13, not far off if selling accelerates. Next up, let's have a look at WTI crude oil, which rose about 3% on Wednesday, closing at 67.58 barrel. The move came after Iran suspended cooperation with the UN nuclear watchdog, adding a geopolitical risk premium to oil prices, even though no actual supply disruptions have occurred. Meanwhile, US crude inventories unexpectedly rose by 3.8 million barrels, and gasoline demand fell to 8.6 million barrels per day, well below the 9 million barrels that's considered healthy for this time of the year. Technically, oil remains caught in a convergence pattern, with price action stalling between $64 and $67. The 9-day and 21-day moving averages have formed a bearish death cross, while the RSI near 50 points to weak momentum. If oil prices fall below 65.93 and $65, we could see a drop towards 63.72. On the upside, a recovery above 65.93 could reignite momentums towards 65.15 and possibly $68. Next up, let's have a look at gold. Gold prices surged again on Wednesday, climbing for a second straight day to trade around $33.55, the highest since June 24th. The move reflects renewed risk aversion after President Trump's tax bill passed the Senate, and as the markets eye the looming 9th of July tariff deadline. The bill is expected to add $3 trillion to the deficit over 10 years, fueling inflation concerns and lifting gold as a safe haven. On the charts, gold remains below the Bollinger Channel's central axis at 33.44. The price has repeatedly tested and failed to break resistance near 3,400. The MACD suggests that the correction isn't over yet, while the RSI near 51 hints at more upside. A firm move above 3,400 could open the door to test resistance at 3,420. On the downside, failure to hold 3,300 could trigger a slide towards 3,250. Lastly, let's have a look at the Australian dollar, which held steady around 65.80 on Wednesday. Domestic retails rose 0.2% in May, better than April's flat reading, but below the expectations of 0.4%. Building approvals also missed forecast, adding to concerns about the economic outlook and reinforcing expectations that the RBA could cut rates again this year, potentially down to 3.1 or even 2.85%. Technically, the Australian dollar maintains a bullish bias with an ascending channel. The pair is trading above its 21-day moving average at 65.12, and the RSI above 50 confirms positive momentum. A break above 65.90 could see the pair target 66.50, while support remains at 65.12 and 64.66. Well, that wraps up today's morning market analysis. Keep an eye on this month's US employment report. It's the key event that could shape today's trading direction across markets. And as always, trade safe, manage your risk, and I'll see you in the markets.